If you aren't already doing 7 figures in revenue with your business, you have room to grow where you're at. Focus there.
Yeah. Grow in your immediate market. I mean, even if it's an hour away, we want you to be in your market to where you are accessible to what you're buying.
Hey everyone, welcome back to the Manage to Exit podcast. My name's Aaron McElhiney again. We've got Hunter Goodall from the PMIA squad, and we've got a special guest this week. We've got Jordan Coleman from Live Oak Bank. That took us a little while to get started today. We've been sitting here for 10, 15 minutes, just pre-gaming for this podcast. But welcome, Jordan. How are you?
I am good. I'm excited. I feel like we hit a lot of conversations on our pregame conversation here, but appreciate the time and inviting me onto your podcast.
Yeah, absolutely. And Hunter, I know you're joining us from Arizona, so we're all kind of scattered today. We got I'm out here in Utah, Jordan's out in Wilmington, North Carolina, Hunter's in Arizona.
Enjoying the sunshine.
Yeah, we got 3 different time zones we're in today.
That is true.
But yeah, just the whole goal of this whole meeting was to get on a podcast, chat a little bit about Live Oak, get to know Jordan a little bit too, and talk acquisitions. Obviously, that's what we do, Hunter and I on the PMI side, purely a resource for property management, business acquisitions. And Jordan, you've got some focus in this too. But yeah, we could dive in a little bit today and share a whole bunch. But yeah, Hunter, I know that you and I had talked a little bit about Live Oak and some of the deals that we were working on, and just kind of want to start it off. Let's throw some ideas out and get the conversation going today.
Yeah, it was really interesting that I was talking to a friend of mine that he went through a business acquisition up in Utah, and I was like, "Oh, okay, tell me about your experience." And he told me, he was like, "Yeah, we went through Live Oak for our SBA loan," and he's just like, "I highly, highly recommend Live Oak." And I was like, "Oh, okay, interesting." And I swear it was the next day. He didn't set this up, by the way, but I had a message from Jordan like, "Hey, I'm with Live Oak Bank. We do a lot of, SBA loans for property management companies. We'd love to talk with you." And I was like, "What? All right, perfect." So yeah, we got on a call, and tell us a little bit about Live Oak. Like, you guys are a big player in the SBA space. Like, talk to us about that.
Yeah. So we are the number one SBA lender in the space. So we started in 2008. So we've been doing SBA loans for a very, very long time. We strategically, I say we, the founder of Live Oak Bank really strategically put a process in place for Live Oak by combining industry expertise, technology, and kind of our key thing is a really, really strong commitment to customer service. We want to look at any of our borrowers or any of our relationships as a partnership. And, we want to make sure that we are extremely transparent and we've got a very strong commitment to what we're looking to do in service. So because we are one of the largest, if not the largest SBA lender in the country, we are a preferred lender. And so what that means on the SBA side is even though this is an SBA loan and buyers are able to benefit from an SBA loan product, we really are able to cut out the SBA. So we never go through the SBA to get anything done. We service the loan, we underwrite the loan, we do everything really internally. So the speed and the process is still just as quick as a typical conventional loan, other than we're abiding by SBA guidelines. And then the last kind of unique thing that I'll mention about Live Oak is that we are not geographically focused like a lot of banks and a lot of local lenders. We are industry focused. So we build out teams in industries that we feel are a little underserved from a financing perspective, yet they're really strong margins, really strong businesses, and we build around that industry. And that's where, Hunter, I kind of came across you on LinkedIn and found you and wanted to connect that way, just with your focus at PMI and Live Oak's focus in the property management industry. Wanted to just connect and see if there's a good partnership for, property management companies out there.
Yeah, it's kind of interesting how you put that because I don't know if a lot of people know how SBA works.
Yeah.
The SBA is not the one giving money. It's the bank that gives money. They're the ones lending on the loan. The SBA is just insuring it for the bank,
Yeah. Yeah,
right?
that's correct. And that's where, you essentially could do an unsecured business loan because the SBA is guaranteeing and backing up 75% of the loan that the bank has lent. Assuming that all, SBA guidelines were met if the loan were to ever go into default. So the SBA is really just a product that, makes any deals a little bit less risky from a banking perspective. So it's not really, like you said, SBA's money. It's not the government's money. It's the bank's money that we're funding. We're just making the transaction less risky for all parties because we've got a 75% guarantee backed by the government.
Yeah, that industry specific piece is super interesting too, because I think, Hunter, you and I both have worked with lenders that we've had to start the conversation with pitching the industry. And so you guys must have seen just an overwhelming need, I'm assuming here, I don't know, just in our PM space, our property management space. Like, when did that department really form from Live Oak?
Yeah, so we are a little newer, meaning that we started looking at property management probably 2 years ago, 2.5 years ago is when we really kind of first said, okay, let's look into this industry. Let's do some research. Let's put some white paper together and see if it makes sense on an industry perspective. Look at the financing ratios. And as we started to learn more and more, 2 years ago is really where we kind of picked up on, okay, this, industry and trends seem to be there. It's a profitable business. Just doesn't seem like there's a ton of education out there that there are financing opportunities other than, I'm going to do a loan to value or a HELOC on my home, or I'm going to do a seller note where sometimes buyers want to cut the seller out of the picture and own the business upright at 100%. And so other than going to a local lender who does, your personal loans, you got a car loan, you can do a HELOC, they don't really understand what you're talking about or how to evaluate and look at a property management business, which again is an unsecured business loan. We're
Yep.
lending to management agreements and door counts. So it started probably 2.5 years ago of the research, and we really started implementing the acquisition and financing side about 2 years ago.
Yeah, I think that lines up. I was definitely seeing more Live Oak, and I know we had a number of buyers that had been working with you guys at some point. And, for Hunter and I, like, this is all we do. And so we've kind of seen that shift of new lenders coming into the space, people really getting comfortable with property
Mhm.
management, but still not having, some of these groups not having industry focus. And so it's nice that they don't need to start that conversation at ground zero when we talk PM. And yeah, there's different risks here, right? As far as assets go. But yeah, let's dive a little bit into Live Oak on SBA and maybe some of the trends that you've been seeing. Obviously Hunter and I are happy to chime in too, just with the increase that we've seen. I'm kind of assuming this is industry wide, but maybe we can talk about the last 12 months or maybe even just this year, like 2025. How's it stacking up? Are you seeing any trends or noticing any kind of deal size increase or decrease?
Yeah, I mean, I would say our average loan size is anywhere between 1.5 million from a loan perspective. Couple trends that we look for in the overall, business itself are door count. Want to make sure that there's not a loss in revenue, loss in door counts on acquisition side. I would say that there's probably a lot more buyers out there that we've talked to than sellers, and buyers saying, hey, I'm ready to buy, I'm ready to grow, but I can't find that right business in that right geographical area that I'm looking for to really be able to expand. So we do a lot of kind of pre-qualifying and conversations on the front end with buyers to get them ready for that acquisition. So I would say that's probably been the largest trend for us is buyers can't seem to find the exact right business to want to purchase or to be able to purchase because it's just not what they're looking for, or they just can't find any in their area as of today.
Totally. And we like to be kind of picky too, like we're not necessarily the buyers in the scenarios, but our clients, our franchisees are the buyers. And in many cases, we're looking at 3 or 5 different deals before
Yeah.
we're really encouraging them to say, all right, now this is the right fit. Let's go talk to the bank. And so we do try to make that process easy just so we're not bringing every deal to the bank. Like we want to be super realistic. But yeah, I think that critical element, especially in the last few years where I think buyers and sellers both have, I think, stepped up a little bit. Like multiples have increased since I've been doing this. 9 years ago, we were buying businesses for like 1 to 2x, and it was amazing. And we do 60 deals a year, and now we're stepping into that kind of 3 to 5x more regularly. Like those sweet deals are not out there. They're still good deals, but it's, I think, even more important now to be more critical, with these higher multiples that we're seeing.
Yeah. I mean, I think you need to do quite a bit of due diligence as a buyer to make sure that it's the right fit for you. Not every transaction and deal is going to be the right fit and really gonna make sense for you as a buyer. So I would agree that due diligence on the front end, you may have to look at a couple before you get to the one that you're like, okay, this is where I really want to buy and put my cash and my effort into. So just making sure that it is that right transaction, door count size, the location, the purchase price, what's their staffing look like, the technology side, a lot of different factors as buyers are looking for that right business to purchase.
That kinda segues into the changes from June 1st that just happened. Because as I
Oh,
was
yeah.
reading through this, and you're probably gonna know more about this than than we are, but as I was reading through it, it seemed to me like what you just touched on of, like, buyers need to be more picky with what they go after, and it seems like these June 1st changes are designed to make people a little bit more picky because we started running into a lot of people just buying businesses, and it wasn't necessarily like the best fit for them. It wasn't the best deal. And so, a lot of people I think are going to be running into a little bit of a headwind with, possible defaults and things like that. And so, maybe talk to us about June 1st changes that happened with the SBA.
Yeah. So what Hunter's referring to is the SBA has what they call their SOP, is their standard operating procedures, which you want to Google it, can. It's about 560 pages long. And every now and again, the SBA does do some changes to their SOP or their requirements, and their most recent changes and updates started and were effective June 1st of 2025. So the biggest change that I see, and I think the reason the SBA did this is, the SBA was a little bit more strict on equity injection in startups and first-time buyers. And then COVID hit, and they started to get a little bit more lax on their rules because of the small businesses and kind of what was happening with the economy. And they have now kind of reverted back to having a little bit more stricter rules and guidelines in regards to, again, equity injection, startups, U.S. citizenship, to where I think the largest impact that I can see in this industry will really be for first time buyers, where essentially equity injection, there's a required 10% equity injection requirement on first time acquisitions, which could be held on a seller note, and the seller could really kind of help alleviate buyers having to bring cash to the project, to where they're saying now, well, buyers now have to bring in a minimum of 5% of cash. And sellers could hold 5% on a seller note, but it has to be on standby for the life of that SBA loan. So they've definitely made it a little bit stricter in regards to what first time buyers can do and bring to the table, which I think is going back to Hunter's comment of, the SBA is kind of almost being a little bit pickier on, are you bringing skin into the game? What does this look like for you? You've got to have some backing to, mitigate this default risk that you've got a little bit more to lose because you put your house up against collateral to put into the transaction. So I think that that's probably going to be the biggest impact. Again, that's for a first time buyer. Obviously, expansion loans, second, third, fourth acquisitions could be up to 100% financing through SBA. But equity injection was probably one of the biggest impacts that I could see that came into effect on June 1st.
Because it wasn't just they had to bring their own cash to the table now, but if anybody puts cash in, even if the seller has cash in, does the seller have to have a personal guarantee for the deal if they're kind of carrying a note there?
So the seller could hold up to 5% on a seller note, but it has to be on standby for the life of the loan. The other 5% has to come from the buyer on cash, which, there's still ways to kind of get around that. Could be, you could have funds gifted to you if you had family, friend, or a member, or you could have a minority investor that is a U.S. citizen put in 5% cash in exchange for 5% stock in the company. Maybe in 2 years, you look to buy that individual out and you don't have to put cash down. If you did have outside income that could support that 5% cash, so for example, you had spouse that could cover a HELOC payment, you could look at doing a HELOC to kind of put in as your 5%. But seller can hold 5% on a seller note, but it does have to be on standby for the life of that SBA loan.
Yeah, I mean, we've had some pushback on that
Yeah.
before. Obviously, I think some deals it might make some sense too to do that. But I'm just lucky because Hunter provided a summarized, an AI summarized version of all these SBA changes,
Oh,
so I
my
could,
friend Chat, my
yeah,
friend
your friend
ChatGPT.
Yeah.
I knew I wasn't going to be able to go through however many hundreds of pages that was, but yeah, it hit on a few points, and I was thinking about our buyer pool, and I'd say, the majority, 75% or more, are existing industry buyers. It might be their first transaction, maybe half of them it's their first deal. Many of them are going through expansion products. But I did think about the first time buyers because I'm thinking about, we've had 2 transactions this year with operators that entered within 6 months and then bought $1 million plus business through SBA. And I was thinking, hey, if that deal was 12 months later, would they have had the same, terms? How could that have impacted the deal? And we're working on one that's closing tomorrow, fingers crossed. That, went outside of an SBA option, and that SBA was something we were looking at first, but decided not to. But so we are seeing an increase of first time buyers. Like historically, if I look back at the last few years, that's a lot of repeat buyers and existing industry people. But yeah, it's just interesting to track that data. Hunter, I think we probably need to be more external with that information because we have a lot. We track all of our deals. I think we've done 450 plus, all property management specific, and we track all of that data, and we don't highlight that enough. But I think you might have some interesting takes on kind of our history too, Jordan. So
Yeah, we're kind of in an interesting spot where, there's this huge wave of everybody that's entrepreneurship through acquisition and just everyone trying to capitalize on the silver tsunami and just buying businesses. And, you know, it's still a risky asset class to buy a business. Even if you have a bank like Live Oak that's like, hey, this deal is approved, we could finance it. It's still a matter of the operator. And I think back again, why the SBA is getting a little bit picky with the loans that they're doing for the June 1st changes is because there's going to be a lot of people who are buying businesses that have never operated a
Yeah.
business. A lot of people are trying to do that for the first time. And I think that's what separates PMI apart is it's like we're helping existing operators buy businesses, someone who's already operating a property management business. Or even, as you mentioned, we had some franchisees that are brand new to this, but they're not doing it alone. They have the support of a franchise backing them to help them be successful in this acquisition. We're going to help you buy this business, but you have this whole corporate office to help make sure that you're successful with this, right? And so I think that's kind of what makes us unique is we have so many hundreds of property management business owners that are ready to buy businesses. And that's why we're really excited about getting connected with Live Oak and with Jordan because you guys focus on property management lending for acquisitions. What is the SBA's thoughts on franchises?
Yeah. So, I mean, just like the bank's perspective, we love franchises because, like you're saying, you're a support system for business owners. That's just kind of one more extra layer of support and backing and mitigating the risk. Obviously, franchises have their own internal, have to be on the SBA franchise directory list. But other than that, I mean, it's a backing for buyers and for business owners to have a franchise that knows what they're doing. They're well-rounded. They've got the team and the support and staffing and are able to kind of help them not just grow and succeed, but able to really help them be profitable on what they're trying to do and listen to their goals and their plans and connect them to the right people for that growth or for whatever they may need. So we love a franchise-backed deal, on an SBA loan, absolutely.
Yeah, I was thinking
Good to
about
hear.
that. And I know, Hunter, you and I talked about this. I mean, when we have something under contract, we have a weekly diligence call with everyone involved, and that could be 5 to 7 or 8 people. And so the majority of that being PMI corporate team members, but also the PMI franchisee buyer. And when we tell people that, there's like, you guys have a weekly diligence call? Like, yeah, we're guiding that whole piece of it. And so that's before it even gets to the bank typically. And so we're equally critical. Like, these businesses have to live within our system. And at the end of the day, like, we need to support them. And then also, they're going to sell that business at some point. And so we might bring another buyer into that business, and we've helped that franchisee build a good business. They did 5 or 6 deals with us, and then they decided to retire and exit. So like, we're full life cycle
Yeah.
of that business and that franchisee. So it's just a different model. And it's hard to explain that to some people that are purely on the buy side. There are some national groups out there, obviously, that do kind of what we do without a franchise model. But yeah, that's interesting to hear about kind of how you guys view franchises. And I've seen that over the years, and I just want to make sure that that we're doing everything we need to do from the franchisor level to make sure that banks are still, confident in these franchises. Of course, we're on that approved list and have been for a long time. But yeah, I think the majority of our franchisees still are existing that are doing deals. Like, they're already in the space, but that trend might be newer franchisees coming in. They're not so much interested really in organic growth. So while that's important, they definitely want to jump in and make that commitment earlier on. Where I think historically we would see people do their first acquisition, maybe within the first 2 years of opening. And now there's definitely an intent to say, oh, hey, I'm going to open up a shop in Wilmington, North Carolina, for example. Perfect example. We just opened an office there. Like, their intent is to buy something within their first 12 months.
Yeah.
And so they're actively hunting too. So I think it is trending a little bit that way. And I'm hoping that SBA is still a good option for them.
How are your franchisees, like, how are you guys finding the right businesses for your franchisees to acquire? Are they the ones kind of out there searching, or do you guys kind of connect sellers and your franchisees together?
Yeah, it's really
Both.
a combination of those. Hunter, I'll let you kind of dive into it, but we do a lot of corporate um, marketing for acquisition lead opportunities. Kyler, our man over here, man
Guy
in
in
the
the
chair,
chair.
he leads up all of our marketing efforts. And we really have just, and I keep saying this date because it's comical. You probably know the numbers better than I do, but we really just formally started marketing for acquisitions this year in April.
Oh, wow.
So we did 400 plus deals before we ever started marketing for them. And so I think we're up over 100. And how many leads are we at so far since April? 140 or
like
more
like
leads
200.
just since
Yeah.
then. And so that's a small amount of the deals. Like, Hunter, you could talk a little bit more about the local sourcing piece, but yeah.
Yeah, it's the best deals. I tell our franchisees the best deals are really going to come from their relationships, right? There's got to be a lot of trust on both sides of the table there to actually have a deal get across the finish line. So I tell people, like, you have an opportunity that we don't. We know how to buy businesses, Aaron and I, and Jordan, you know how to fund them, how to get them across the finish line in terms of like SBA lending and things like that. But the best deals are going to come from them going out and shaking hands, right? That's seriously the best deals are going to come from that is go introduce yourself. Aaron and I, we just trained a week ago on this to a group of new franchisees, but I was just listening to Cody Sanchez's book, and she said a really great line in there. She said, "Deals go to the door knockers, not the mouse clickers." Right? So Aaron and I, with our guy in the chair, Kyler, he's doing all these marketing efforts. We're the mouse clickers, but
Yeah.
we're also canvassing the whole country because we have buyers everywhere. But the best deals are going to come from them actually going out and shaking hands. And so we teach that to a lot of our franchisees. Like, it does not hurt to have a good relationship with your competition. Like, go meet the other owners because that's likely where your deal is going to come from.
Yeah.
Besides that, we do a lot of our own hunting. So sometimes it's like, hey, we see who are our best buyers. I'm going to target a certain market where we have a handful of buyers, and I'm going to just start contacting these companies and be like, hey, if we had a buyer, would you be interested in selling? And I get a lot of people that are like, actually, yeah, you know.
Good idea. And I could not emphasize more on that I feel like the smoothest transactions are where buyers and sellers have some type of relationship. Everyone is just kind of a little bit more engaged and everyone knows everybody from a personal kind of standpoint, even if it is your competitor. But the networking side on maybe you're going and meeting someone today with just no real intention, but that may benefit you in 12 or 24 months of you're kind of out there networking, even again, if it's with your competitor, they may be ready to retire in 24 months and are starting to think about an exit strategy and convenient timing that you're running this business, you're an independent local individual running the same business. And, you never know what opportunity is going to come, but the relationship between a buyer and a seller, them having that makes transactions 100 times smoother. Not saying that can't do a transaction without a relationship because we do that all the time, but it's definitely there's a pro to really getting yourself out there and meeting these people in your local network.
Totally.
That's
Like
where the deals come from. It is.
yeah, we hit on that all the time. And I think we're around 95% of our transactions. Hunter, that number I might be misquoting. I think we're around 95% of our closed deals are off-market deals. And so a lot of that is attributed to those franchisees that are out hunting. And I think just on like a national stage, and maybe this is something that we're still trying to get over with our marketing efforts, like people assume sometimes that they don't know PMI, that we're the buyers, we're like this huge national company and we're buying all these companies. And once we actually talk to someone, it's, oh no, our guy actually, he's on Miller and 7th Street. Like he's PMI so and so. Like they might go to the same Starbucks on Wednesday and not know each other. Like our buyer is like in your community already. And so when we get over that hurdle, like it's really interesting. Like that changes. That's, hey, can you meet tomorrow? It's not scheduling a flight. It's,
Yeah.
hey, the guy's down the street. And so that's something we keep having to get over. But that local buyer element, like you never know when someone wants to sell or maybe needs to sell. And Hunter and I have dealt with that. And I'm sure you have too. Or, hey, there's a situation and the seller, their plans have changed for whatever reason. Could be their health, family members' health, something came up in their lives they need to sell. And so we get calls from people like that, just says, hey, I know we spoke 6 months ago. I know I told you I was 3 or 5 years away, but hey, what can you guys do for me in 3 to 4 months? And, we have some flexibility, but that phone call would have never happened if we weren't proactively outreaching
Right.
and, putting our hand in there.
So we have an interesting chart where we tracked like all of our active deals that we were working on, from just found, discovery, valuation, due diligence, closing, close lost, right? And I separated them between off market and public listings. And it's like we had, 5 or 6 deals in each stage, and they were almost all off market deals. And then in closed lost, it was like huge chart of, it was like 100 plus public listings that were just closed lost, and none of them were progressing towards close. And so it's like public listings are really hard to win because they're so competitive, and you're not going to, as a buyer, you're not going to get a good deal, right? But I'm curious, you guys do a lot of property management lending. What do you see on that? Like, are most of the deals public listings, or are they off market?
It's going to be more off market. I mean, it's going to be the ones that have a direct relationship with one another. like you're saying, all of these deals that you see on market, one, they're not going to cash flow. They're asking for way too much than what the business can really support. Two, there's probably going to be $500,000 worth of seller ad backs that we're going to look at and say, this just doesn't seem to make any sense.
Yep.
That
Um,
doesn't count. That doesn't
yeah, we're
count.
not putting a $20 gas bill from 3 years ago into our cash flow. Um, and it's like you said, it's extremely competitive and they go very quickly, which as an independent buyer that needs financing, it's you just, unless you're a cash buyer that can put $2 million up on these market deals, it's going to be extremely hard for you to really be able to win any type of bid on kind of moving forward. So we get a lot of inquiries about, hey, I saw this on this website. Can you pre-qualify me? And we could get somewhere close to what they're asking for, but it's the relationship between, just even if it's not a relationship between buyer and seller, it's you guys connecting a buyer and seller. There's some type of connection that is off market to where it makes more sense and there's actual true financial due diligence from the financing perspective that's kind of already been completed that makes sense to be able to lend to versus the off market crazy seller ad back discretionary earnings.
Yeah, we love that. We like constantly, are super critical of that. We're like, really, 100% of all of those
Yeah,
are all that's amazing. Like that's unheard of.
you've done 50,000 of expenses, that's it, after you've added everything else back.
Yeah, you had a great 6 months before you decided to
Yeah.
sell.
What are some of the common ad backs as a bank that you're like, no, that doesn't count? Because when I look at it, I'm like, people, they always try to add back meals and
Yes.
travel. And I'm like, I'm not adding all that back.
Yeah.
And I don't think the bank will either. Like, what are some of the common ad backs that you're like, no, that doesn't count?
To me, anything less than, like, $3,000, I'm not gonna look at. Sometimes it's even 5,000. If I have to nickel and dime to make a cash flow work, it is not worth what you're gonna be trying to pay for it. So,
Yep.
Mm.
I want to look at larger add back expenses that truly make sense. Salaries, the payroll, maybe the technology, maybe there was consulting that truly makes sense for a buyer versus this, travel expense of a vehicle from going to my home to this place. I'm not gonna collect a gas bill for every week of what you've done.
That is not going to impact the value at
No,
all.
and if it does, it's not worth what they're asking for. So we really try to be realistic on our ad backs, and if it's a small amount, and again, we're nickel and diming the cash flow, it's not worth putting it into the cash flow.
Yeah, you should be confident enough with those larger items.
Yes.
And if there's other benefits there, that's purely for the buyer down the road, but that's not for the deal.
Yeah.
Yeah.
It's, you'd be surprised at what people will come up with to try to add back into their cash flow.
I'm sure you've seen maybe more than we have with that, but yeah, and just that, and I've seen, just these over projected values for year-end finishes, and I'm just like, I can't look at what you think is gonna be there in 6 months. Like, I need to look at last year and get really comfortable with the last 3 years.
Yeah.
But yeah, I mean, how do you guys view that too? I'm just thinking about even some of the roll-up scenarios that we're with, right? Where in some cases we need the whole team and we need the new office, but sometimes we don't, and we're really just absorbing the contracts. Is that something you guys are looking at quite a bit?
Yeah. So obviously, each transaction is dependent on the buyer. Each buyer will impact what they can afford from a cash flow basis, what they can afford from a loan amount basis. So we are a cash flow based lender. So we do, just like you're saying, look at 3 years of tax returns, want to see positive trends, want to see the door count increase. Year to date financials are kind of weighing out. We don't look at a projection based cash flow. So, like you're saying, well, in 6 months, I'm supposed to be getting this huge client to add on. Well, that's great, but that's not impacting your today's cash flow. So we can't lend on that. It's got to be based off of what we're looking at today. But we can look at it from like an projection standpoint. So we can look at adjustments and we can add those salaries back in if at the end of the day you don't need their staffing, you don't need their rent, you've got your own physical location. So we can look at true add backs that make sense for a buyer if they've already got an established business that they're operating. So we look at historical financials to kind of start it, but then we will cater the cash flow to each specific buyer based off of what they really need to do with the business.
That's really interesting because I don't make those adjustments. When, like, I'm looking at a deal right now where they're like, "Oh, we just let go of an employee," and I'm like, I am not adding that salary back because how do I know they weren't critical to how this operated in over the last 3 years,
Yeah.
right? I don't whatever their forecasts of, "Oh, we eliminated this rent." All right, if they eliminated a lease, "Hey, we've gone remote." Okay, that's fine, but in terms of, like, general operation, they make adjustments. I'm like, "That's unproven."
Yeah.
Whatever you just changed is going to impact every part of this business. It's going to impact the revenue potentially, impact the cash flow. It's unproven. If you want to structure the deal with those forecasts, we're going to do some sort of creative structure with an earnout if the business continues to hit certain benchmarks. But if you want to cash out, those adjustments are not going to impact my valuation.
Yeah. And you really want to make sure that you don't need to replace these people that they're saying that they can get rid of, because
Yeah.
that's essentially, like you're saying, is a wash. But if, the other kind of a red flag for us is if they did lose their key man, like you're mentioning, within the last 6 to 12 months, the question to the bank is, like you're saying, okay, well, you as a new buyer, let's talk about, why did the seller lose that individual? Is there something going on internally that we don't know about? And then you will see, is there a decline in the door count or the revenues when they've let this person go or these people go? So there's definitely a story to tell as you're analyzing and looking. But I think for a buyer, understanding what you're buying is going to be very important for us to kind of help to finance any type of acquisition.
Yeah, you brought up the red flag piece, and I think all of that insight is super helpful for buyers and sellers, right? There's a lot of sellers that are probably going to listen to this, kind of prepping for the exit. Like they may, and I've seen this, I'm sure you have too, seen people running it slimmer for the last year to add back a salary and try to push that into it. But what other red flags, like anything even more recent, any like good examples from what you can talk about, any other red flags that buyers should be aware of?
To me, a couple different red flags would be owner concentration on an acquisition. Want to make sure that it's not heavily concentrated on one or two owners of the portfolio you're buying. If it is, that's a red flag and hard for the bank to want to proceed with, just because if you lose one or two owners, well, there may go 50 to 60% of your cash flow. And then just the overall trend of the door count and the revenue is pretty important to kind of understand the top high level bird's eye view of the business. Again, are they declining in 3 years? Have they lost doors? Has their rent gone down? There's a story that we can't quite understand. Let's dig into what's happening a little bit more to get us a little more comfortable on what you're buying.
Yeah, definitely. I was thinking of one that came up recently where the seller actually owned a pretty large amount of the single family properties in the portfolio and wasn't charging himself for that management, right? He considered it like taking money from one pocket, putting in the other, but was still trying to exit with some value on those contracts. But yeah, we will see that. There's obviously a lot of investors turned property managers over the years and oftentimes are managing their own portfolio. Sometimes they are charging for it. And we've done deals where, hey, we need to get new agreements and we put 3 or 4 year terms on some of those properties. But have you dealt with that at all where one of the clients was actually the seller?
Of like the portfolio.
Yeah.
We have. And, again, it kind of goes back to, are they going to keep those homes in the portfolio? If they aren't, what are they charging themselves? Let's kind of make an adjustment to exclude those, because it's not fair to give value to the business if it's something that's going to be going away. Or if they are going to be keeping them, just kind of getting a good understanding of, okay, well, what percentage of revenue is kind of dictated by the seller, and how many homes is that? Is that a majority? Is that a very
Yeah.
small portion? So it's just really understanding like the portfolio as a whole on seller's side and what that looks like.
Yeah, and if it's a small enough portfolio and they're willing to sign a new agreement on it and we've got good terms on it, I think there's some value there for the seller. We treat it just like we would any other client's property. But I have seen that issue come up before. Trying to think about other things that we've run into more recently. I'm really curious to get your feedback on including real estate or commercial space within an SBA backed product. We went through one recently in Arizona where we were about to include the office space. Ended up just not working. We pulled that out of it, but we are seeing that opportunity to include some commercial space. Do you do a fair amount of SBA with real estate?
Yeah. I mean, you're eligible for up to 25 years on a loan term when there's commercial real estate involved, depending on what percentage of the commercial real estate is allocated towards the overall loan package. So if 51% or more of your purchase price and loan amount is allocated towards CRE, commercial real estate, you get a 25-year loan term, which is inclusive of all of the business assets that you're looking to buy. So, I mean, we love a rent roll replacement, right? It's an asset for the buyer to put on their balance sheet. They've now got a place to truly operate out of. They don't have to be on a annual lease potentially or a month-to-month lease. So yes, I mean we deal with a fair amount of commercial real estate, and if that's part of the acquisition, it's only going to make the transaction that much stronger because you can go out on that loan term. You could still be eligible for 100% financing to where you're not having to put cash down. So yeah, we absolutely love commercial real estate as long as your business is occupying 51% or more of that space, you're eligible for 100% financing.
And that's a 504 loan, right? Because there's a difference, 504 and 7A.
That's still an SBA 7A loan.
Oh, okay.
Yeah, so your 7A loan can be inclusive of real estate. The 504 side is really going to be catered more towards just real estate. On maybe
Just
you're
real
doing
estate.
like a ground up construction project, or maybe you've got a really large commercial property that you're looking to purchase. So you could be eligible on the 504 side there, but the 7A loan will be inclusive of the business acquisition where the 504 won't finance that, your commercial real estate, your closing costs. And we typically like to give 30, 45 days of working capital for any acquisition inclusive in the loan just to kind of help with that first couple of weeks of transition. Some buyers don't need it, some buyers don't want it. So really just kind of dependent on what they want or need, but that's typically what we try to include in our acquisition loans.
That's
And
great. Just kind of
so
help them transition out a little bit, right? It takes a little buffer off the first month. So
Yeah, lets them have a little bit of cash on their balance sheet. If sellers are kind of taking all of the cash in the existing accounts where you've got some true operating cash to help with your expenses on day one as soon as you take over, you've got kind of that buffer there to help you with that transition.
that's probably an often overlooked element.
Working
Like
capital.
working capital, a lot of people miss that. They're just like, here's the value of the business. I need a loan for this much. And it's like, well, let's get you a buffer because you got to make payroll a week after you close on this. So
Yeah, you've got expenses that you are gonna have to start paying as soon as you take over the business. You wanna make sure you've got a little bit put away for when you need that, and then obviously you start operating and you can put that operating cash away, but we really wanna try to give working capital that makes sense for each buyer, typically 30, 45 days of operating expenses.
the cool thing about Live Oak is you guys typically have a pretty low interest rate. You guys are prime plus what?
Could be anywhere. I mean, interest rates will really vary on the credit quality of the guarantors, credit quality of the overall cash flow, and the loan size. So, obviously, the larger your loan size, the more competitive we're able to get. The lower your loan size, 500,000 and less, we're not able to get quite as competitive. But I mean, we've seen interest rate anywhere from prime plus a half to prime plus 1.5. Yeah, prime today is 7.5. So it really just kind of depends and varies on a couple different characteristics, but that would be kind of the median range of what we've kind of seen in the past year or two.
Now, because it's on loan size, You probably get a lower interest rate if you do one of these 7A loans with a building involved.
Yeah, I mean, that's larger purchase price. You're able to kind of go up a little bit on multiple from kind of our underwriting standards and how we look at that. And, you know, larger loan size, get a little more competitive on rate. We are now no longer an unsecured business loan. We've got a little bit of real estate attached to the loan as well. So, I mean, yeah, you can definitely get a little more competitive when there's commercial real estate included.
Does that, when you add the real estate, you can extend the loan out? Because normally an SBA loan is 10% down
Hmm.
over 10 years. The interest rate is going to be prime plus X.
Hmm.
Um, but if you add real estate, now it's going to extend not just 10 years, it's going to be 20, 25 years,
Yep,
right?
potentially 25 years. So 51% or more allocated towards real estate on your purchase price, you get a 25-year loan term. If it's under 51%, you'll have a blended term of anywhere between 12 to 25 years, kind of depending on what the allocation to real estate is compared to the overall loan amount. So you're able to extend your debt out longer, but again, it's one loan. So you don't have a business loan, you don't have a real estate loan. You've got one loan that's inclusive of this acquisition that includes your real estate, your business acquisition, working capital, and closing costs, and all amortized over 25 years or a blended term depending on that allocation. And if you're an existing operator, you're 100% financing, you're not putting cash down on the real estate. If you're first time acquisition, there would be a 10% equity injection of the total project.
So SBA loans, it's like a person has a max limit of $5 million in SBA loans in their life. So even if they pay off, hey, I took out $1 million SBA loan and I paid it off 4 years later, they still only have access to 4 million left after that, right?
You
Does it change with real estate?
it's a $5 million SBA runway based off of your loan balance. So if you got $1 million loan today and you paid it off in 3 years and you come back and say I want a $5 million SBA loan, you're eligible for 5 million. It's of your existing loan balance.
Gotcha.
Yep.
Wow, okay. I thought it was over the life of a person, you could max out at 5 million.
Nope.
But you can, if you pay it down, you can go back and get another 5 million.
Yep. It's of the
Oh, that's
outstanding loan
awesome.
balances.
I think we've had so many buyer conversations where they're kind of in that 3 to 4 mil space already on pretty recent buys, and they're kind of looking at like, hey, what can I do to get like they don't want to stop buying, and they're looking at creative options, trying to think what's beyond that, for that buyer that needs to extend past the 5 and get into some larger transactions. Does Live Oak have the options for that as well?
Yeah, so I mean, there's a couple different ways that we could, we try to get as creative as possible when it makes sense for the bank as well as the buyer. But I mean, we could look at, depending on each case, look at trying to extend past that 5 million and reducing our guarantee, which is just more risky to the bank. But the 5 million is capped because of the SBA guarantee fee. So if we start reducing that guarantee fee, your leverage of the SBA runway starts to extend a little bit. You could also, I mean, again, trying to kind of get creative. It's not necessarily bank financing, but maybe you do seller note financing and you look in 2 years to refinance that with SBA debt because you'll have runway. Well, that's a potential opportunity on close on the loan. You do seller note financing. You look and your intent is to refinance that in 2 years because you're eligible at that point to refinance seller note. And you have more SBA runway because you've paid down your existing loan down pretty quickly. We do have conventional products as well. They're just going to be a little less favorable, and our credit box is much greater than on an SBA loan because again, there's no SBA guarantee to back up any loans. It's strictly just 100% risk to the bank. So there's a lot more liquidity requirements that we want to see on a personal financial statement. Our debt service coverage is way up. Loan term has gone from 10 years on an SBA loan to a 5-year loan. So it's, a lot of different characteristics have to play out and make sense on a conventional structure for a business loan.
Sure. I mean, I think there are some strategic buyers that Hunter and I are thinking about already that might fit that small box, but I think there's still such a huge amount of opportunity just with traditional SBA just for our space.
Yeah.
And like your point, you can get pretty creative on including other seller finance elements with that. But yeah, I do see just the trend of people kind of extending past that window, and hopefully that debt's getting serviced in a fair term that, they can, you know, put that to work again on their next deal. But I think Hunter and I, just based on the conversations we've even had just recently, like over the next 12 to 24 months, we'll see more people maxing out with SBA, just kind of within our network. That's without real estate, by the way. But we are super interested in doing some more commercial real estate too. And one thing that came up the other day, there was a buyer that said, "Oh, I don't really want that office building," and they assumed that they had to buy the seller's office building. Like, can you talk about that a little bit too, as far as like commercial space with the transaction, not necessarily part of the original deal,
Yeah.
right?
It's like buying a book of business from one seller and buying a completely other piece of commercial real estate from another seller. Yeah, I mean, absolutely. It's still a commercial real estate purchase. It's still a business acquisition purchase. We got to make sure that cash flow can support the combined debt. The only other factor to think about as a buyer is you do have two sellers. You've now got kind of your one seller on the business side. You've also got one seller on the commercial real estate side. So, not saying it can't be done, and we haven't done it in the past, but you do kind of have to be weary and understand that you have two sellers, but it's going to be one loan. So we got to make sure kind of both parties are on the same page of closing. That if one side kind of has a little bit of a speed hump, you need to make sure that this side is going to be okay. But yeah, I mean, if you want to buy a completely separate commercial real estate in another location and it makes sense for you and the business, I mean, absolutely. If it makes sense for you and it's not going to mess up the operations of the business itself, we can definitely help to finance that.
Yeah, I could see how timing that with all these parties involved may be difficult. But let's talk. I mean, Hunter and I get a lot of push on this when we're talking with sellers that have some time constraints. And, a lot of our offers and our buyers' offers do have kind of an A and B option as far as, hey, here's an SBA type route, here's a seller financed route. Like, we get pushback on the time to fund with SBA. And, our whole goal really, even while we're kind of, working closer and closer with Live Oak, is to, hopefully speed that up a little bit too. But like, what are you typically seeing as far as SBA turn time? Like, is it still that 3 to 4 month window that people have been used to historically?
No, that is a big myth on SBA, which is one thing people hear us say, yes, we're the number one SBA lender in the country. And they'll say, ugh, I don't really want to go the SBA route. And we say, well, why? Tell me, what do you not like about it? They say it's the timing. Then I kind of have to explain, okay, but we're a preferred lender. So again, our process from start to finish, the main holdup is a buyer and a seller. Sellers go on vacation. Buyers have to go do this or are busy at work. And so our timeline is really dictated on buyer and seller. Is your attorney in the state? Have they created your purchase agreement? Do you have the financials? Are we waiting on accountants to get you year-to-date interim financials? So, I mean, we can close a straight business acquisition to where we're not ordering appraisals on CRE. We're ordering a business valuation that comes in 7 days. We can close within 30 to 45 days once we
That's
have,
amazing.
yeah, once we have all of the financial information and buyers and sellers have agreed to a purchase price. That's typically going to be the biggest holdup, our buyers and sellers.
I think our record is like 60 days, by the way, and I was actually kind of happy with that. So you saying 45, I
No,
get that
we
a lot.
weren't happy. We need 45.
Yeah, a lot of stars have to align for 45 days, but still, we've dealt a lot with the 3 to 4 month window, like historically,
Yeah.
and that's probably not the bank's fault in any way, but I think a lot of people have heard that too, whether they've gone through the process or not. They're just not prepared for that time wait.
Yeah, it's really going to be how much due diligence have you done on the front end? Where are you in relation to your purchase agreement? And have you guys agreed to a purchase price? Because I mean, people say, well, I want to close at the beginning of October and they think they've got a lot of time, which you do. But if you don't start doing your due diligence and you're negotiating on purchase price starts September 15th, well, yeah, you're not going to close October 1st. you kind of have to go ahead and start getting your ducks in a row and make sure you've got your purchase price agreed to, make sure you've got your financial due diligence in hand to where you can hand it to the bank or PMI and we can kind of run with it. And then we can really kind of start moving. It's really where the buyers and sellers are not in agreement on the time frame.
Sure. And I'm just guessing too that if we have a buyer that's probably gone through the process before, right, and this might be their second or third transaction, I think we can definitely speed it up. That first one always seems to, for first time buyers, always a little bit of a process. But like I said, many of ours that are on deal 2, 3, 4, we've done 8 transactions with a single office too. Like I'm pretty sure that that buyer would qualify for maybe some of the larger products you mentioned, but also could probably, with the help of his team and our team, get that 45-day close. I'm just guessing, but I think that buyer experience is key too.
Yeah. I mean, they kind of are, if they've been through the process once, kind of know what to expect. I mean, obviously, there's, application documents and documents you've got to fill out and kind of provide to the bank. But, we've done this again since 2008, and we've got a team built out for property management, and we've got a process on what this looks like and how this works. And I know I told you guys this before, but time kills deals. And if buyers and sellers just kind of sit on stuff or don't want to be proactive until a month before closing to even start their due diligence, well, you're going to come up with some hurdles. You kind of need to just move on it, know what you want to do, and let's move forward.
Yeah, we try to do as much upfront diligence as possible so that I don't want to have to go and renegotiate a purchase
Yeah.
price. What we put on the LOI, I'm like, I want it to be this price. Please don't make us like renegotiate this because the first 2 weeks of due diligence, we're going to do legal and re-review financial to make sure, do we need to renegotiate? And then we'll start our purchase agreement.
Yeah.
But, yeah, I don't want to have to go back through that. We've had to do that a couple times, and it's like, man, this like, unfortunately, we found a red flag. We found a skeleton. It's like, dang it, you should have told us this before,
Yeah.
you know?
Don't want to go.
Yeah,
Um,
we could have helped you if you would have just said this 30 days ago. Yeah.
yeah. So with that though, like, when should a buyer go talk to the bank? And how should they prepare for that initial conversation? Do they need to have a deal already lined up to come and talk to you? Like, when do you think they should come and talk?
No, I mean, I don't think it's ever too early to start the conversations for a couple different reasons. One, can kind of walk buyers through what does our process look like so they're aware of what this is going to look like. Two, give them an idea of this is what we typically ask for buyers on the front end, for sellers, and for individual guarantors. So they've now got a list, even if they're not ready for 6 months, of what we're going to ask for. So go ahead and start collecting your information or go ahead and kind of start thinking about what this could look like. And then we're also having a conversation of let's talk about structure. Are you putting in 10%? Where is that coming from? Is that eligible? Are you thinking of 100% financing? What are your goals? What are you kind of looking for? So we do a lot of like pre-qualifying on a buyer side just to say, hey, everything looks good. You guys are checked out. Your existing business operates fine. Your credit score looks fine. Personal financial statements checks out. And that may give some reassurance to sellers on, hey, I've talked to a bank. They understand the property management industry. They're the number one SBA lender in the country. I've got a pre-approval letter for me individually. I'm serious in wanting to buy your business. Here's my pre-qualification letter. Now it's kind of your turn to provide the financials to start the due diligence on your end. So I never think it's too early, even if, again, it's 6, 12 months down the road to start the conversation and start that relationship and completely open to, walking through questions, ironing out any scenarios, gives buyers kind of an idea of what they want to be looking for and what that looks like for them.
Careful, because we're gonna send 470 people to schedule calls with you.
Your marketing that started in April.
Yeah.
And there's
What
still the 8 offices every month being added. So that
Oh,
list
good.
is just gonna
what,
no.
what questions should they come prepared with? Should a buyer come and talk to you with?
Um, I mean, I think there's no right or wrong question. I think if especially if you're not super familiar with the bank or SBA or the process. Just come loaded with all of the questions that you have. There's no dumb question. It's I do this every day, so it's what I do. You run the property management company. So we're really here again to be a partner on transactions and to help buyers get to what they're trying to do. So I would just be prepared to come with as many questions that you have to try to understand what's next. How do I start the process? What does this look like? So we can, as much information that we can get up front from a buyer and there's no surprises later on, the better for us.
Yeah, I'd say just part of our role too, like the expectation setting piece that we have. And just historically, we haven't really been bringing deals to the bank until we have a signed LOI because we've been confident enough to say, hey, we know the bank's going to like this based on some criteria we've worked on before. But yeah, I mean, we prep a lot of our buyers too. We're like, hey, it might be 10 to 20% down. Hopefully it's less. And so usually we're in that 5% or even zero. But like that's kind of the quality of our buyers. Like they're prepared. They've got cash to put at these deals. We're hoping they don't have to use it all because what we've noticed is we closed one deal with one of those offices, and within a few months of closing, something else shows up.
Yeah.
They always happen. Like I don't know what it is. Maybe it's marketing. I don't know, but but yeah, they always seem to stack up like that. And so we've done a few where, and maybe you could speak to this too. Like, are there any restrictions around someone utilizing an SBA product, 2 or 3 times in a year? I know we've just done one within 2 deals within 6 months, but have you seen 3, 4, 5 transactions in a single calendar year?
Probably not 4 or 5. We've seen 2 or 3. Again, it's all really going to be based off of that individual buyer. If they're an extremely strong buyer and it's in their market, they're buying their competitor and it makes sense and they've got a business plan and the manpower to support it and they've got SBA runway, I mean, then yeah, we can definitely kind of help facilitate what that looks like. If you're getting past 3 in a single year, would kind of want to understand. I don't know if credit would say, let's give it a couple months, kind of let the transition be smooth and then look at doing this in a little bit. I think it's really just kind of case by case on target cash flow and that existing operator.
You said a really key phrase. Let's rewind there. In your market. So many people wanna look in different markets to buy a business, and I'm like,
Ew.
"No. If you've done 3 deals, go for it. Go look in a different market, but
Yeah.
if you've done 1 or 2, like, you need to be where you're buying."
Yeah. Yeah. I mean,
Like, how do you guys feel about that?
for your first time acquisitions, our credit stance is you have to be in the market for your first time acquisition. It's too risky to try to run a business when you're in New York and the business is out in California. Especially with, different rules and regulations in different states. If you're not in that
And look at
state,
all those time zones.
yeah, we're currently on 3 different time zones right now. As you start to expand and grow your business operations and you have gone to 3, 4 acquisitions, yes, we can look at doing different state operations if it makes sense. Again, if you've got that business plan that makes sense. I will say one update on the SBA SOP rules is if you are buying in different states or a different geographical area, let's say 7-hour drive, you would be required to bring in cash to that project. That is one change that the SBA has updated as of June 1st. But these are the conversations where, again, if you're a buyer, it's never too early to have these conversations. So I can kind of try to prepare you on what this could look like for you, or what is your goals, what is your plans, where are you buying? It's never too early to start the conversation.
Yeah, I think Hunter's been jaded by that before, where we have franchisees that, get really excited about a new market. And I think while we love kind of that multi-unit franchise owner mindset, I think there's definitely a stepping stone to getting there. And that's going to usually be a series of acquisitions in your key market.
Yes.
And I think it's even more recently that we had a buyer in the Midwest that went to their second state for the first time, but that was their 8th transaction.
Yeah.
So they really saturated deep in their key Midwest market and now are looking for that. But But yeah, we encourage that too. So I'm glad the bank is on the same wavelength as we are.
I'm like, one, if you haven't done multiple deals and know what to expect. Two, if you aren't already doing seven figures in revenue with your business, you have room to grow where
Yeah.
you're at. Focus
Yes.
there.
Yeah.
Like,
Yep.
Grow in your immediate market. I mean, even if it's an hour away, we want you to be in your market to where you are accessible to what you're buying.
Totally. Just the add back values too. It's just, hey, we can confidently step into these. We know there's going to be some overlap and, purely to the buyer benefit on that. But yeah, we run into that quite a lot, even just today. And for us, it's unique too because we have a franchise element where, hey, there might be a new territory cost, a new franchise cost to that we might need to include in the bank loan also as part of the deal. So
Yeah.
good
and
things to
there's
go
there's a
through
reason.
early on.
Yeah.
There's a reason for the guardrails. The SBA has guardrails. We put up guardrails and we tell people whenever we look at businesses, we look at it through the eyes of like, would I buy this?
Yeah.
If I would not buy this, I will tell you I would not buy this, right? But we put up these guardrails and these recommendations. Don't buy outside of your market because I think people often forget business acquisitions is a very risky asset class. Like it's not like you're investing in the S&P 500 or something. Like it's not like you're buying real estate, but it is better than buying crypto. but I mean, it's a risky asset class, so it's like there's a reason experts say do this, don't do this because it's like we don't want people to fail, you know?
Right. Yeah. I mean, and we're very I mean, we look at more deals and say it doesn't seem to make sense, and we do. Yes, go for it because there's so much due diligence and protection on the buyer standpoint that we want to make sure it just makes sense. So I would agree 100% with that.
We look at every deal through that lens. And it's like when we find a deal, we hand select like you would be a good buyer for this one. Or hey, this deal is not right for you. Maybe this one is actually too small for you. I want you to go find a bigger one. And we've actually just recently we had a deal come up like that where we were like, franchisee actually went out and found a deal and we were like, this is actually a great deal, but I don't think it's a great deal for you. It's a great deal for this guy.
Yeah.
Let's find you another one.
Yeah.
Right. So
Yeah, you
you
need
know, we
something bigger with team. Like that's a big piece for our deals too. Like we're looking for staff. Like that's a huge element to this. And, so it's interesting because we do have franchisees that are targeting specific businesses just to get like, hey, I want to hire that GM. He's, like, so there's a little bit of that too. But yeah, Hunter kind of mentioned it. Like if we weren't confident enough to, buy it ourselves, or even if we were to personally lend on one of these, then we're not going to encourage one of our buyers step in. We're not going to bring it to the bank. Like if we wouldn't lend on it ourselves, that's kind of just our internal mentality that some people are just surprised to hear because sometimes it's just large group buy everything. It's like, no, like we turn away so much too. And, it's at the end of the day, it's totally worth the hours that you're putting into things that you're figuring out are not a fit. In the long run, it plays out.
I've got a question for you, Jordan. I know we might be running short on time, but what do you wish sellers would know when they're trying to sell their business? Buyers are trying to get an SBA loan. What do you wish sellers would know for this process?
So recently, I probably run into sellers don't want to provide financials. I'm sure you guys don't get that very often, just with the due diligence that you guys do. But I have come across probably 6 different times in the past month of, I would like to buy this business. I'm buying the management contracts. I can't get financials. And sellers saying just because you're buying the management contracts, you can look at my door count and revenue and do a 1.5 times of revenue, to where from a cash flow perspective, we've got to look at tax returns. You're selling a business. So we've got to look at some financials and what does that look like for a new buyer to take over, even if we can add back these expenses. So to me, that's one big thing is if you're a seller, you've got to release your tax returns. We've got to see some financials. And then the second thing would be in the market, really any industry. I feel like since COVID, there's been a lot of consolidators eating up more independent businesses. not just in the property management space, but independent buyers don't have the cash to put down and have as a multiple as a consolidator that can pay straight investor cash or cash to the project. So it's, you may not get quite as much potentially with an independent individual needing the actual financing, but you're going to have that touch in your business post closing in the community with that individual and them being there and it not being a consolidator. So I guess that would be kind of like my two piece there is please provide your tax returns if you're a seller.
Yeah, it's, that last part kind of setting the expectations of buyer profiles for the seller. It's, we tell them, "You could go get a private equity, really hard to sell to them, but they will give you a ton of
Yeah,
cash, but they're not gonna be the ones operating this business."
correct.
There's a lot of strings that are attached with that, right? You could get one of these kids that are coming out of college, going through these guru training programs, entrepreneurship through acquisition. They're gonna get their first deal. They're not gonna be able to pay you as much, and they don't know how to operate this. So you gotta hold their hand for it.
Right.
Strategic operators, people who are already operating it, they know how to operate this business. They're going to be able to take care of your clients, take care of your employees. They're not going to pay as much as the private equity groups, the institutional money. They're probably going to pay a little bit more maybe than the entrepreneur through acquisition guy, but there's still that expectation. Sellers, in fact, I'm dealing with this on a deal in California where the seller wants 3 million for his business, and I have to explain to him something about debt service coverage ratio,
Yeah.
where I'm like, it will take 15 years of zero paychecks to pay this off,
Right.
right? So debt service coverage ratio, like that's what are y'all's requirements? Is it 1.5?
Ours is
1.15?
1.25.
Oh,
But
1.25.
that does,
we're close.
yeah, that takes into account the buyer taking a salary from the business. So, like you're saying, again, each buyer will dictate an overall cash flow and an overall project. So, we want to make sure a buyer can afford the business from a debt service coverage standpoint, but still pay themselves a salary if needed. If they've got an existing business, maybe they don't need to take a salary. So, you could probably get a little bit more from a loan amount potentially. So we underwrite to that 1.25 debt service coverage, but each buyer is going to dictate what your overall project is going to look like.
Yeah, the business has to be able to pay for itself. Like,
Yes.
the bank looks, buyer, are you qualified as an individual to buy this business? Business, can you pay for yourself? Like, you have to be able to pay for yourself from a debt service standpoint as a business. And that's something that I think sellers need to be aware of like, there's a reason, like there's a science and an art to valuation. And the science is, can the business pay for itself? And then the art is, okay, how are we going to structure the deal so that the business can pay for itself? But that's the primary thing. Can the business, it has to be able to pay for itself,
Well,
right?
and then if you were that seller, put yourself in the buyer's shoes. Why would you buy a business where on day one you're in the red and then you're in the red for the rest of your life until the loan's paid off or goes into default? So why would
Yep.
you make a buyer pay for something where the cash flow is not quite there? So yes, it's got a cash flow.
Yeah, I mean, there's a lot of education that we're even pushing out to sellers, trying to prep them for the exit. And, that expectation setting piece is critical because we know and we're learning more and more what the bank wants, right? And so, yeah, those crazy multiples, they might exist for the tech company that's down the street. But at the end of the day, you cleared $1 million last year and this is what it looks like. So we're super transparent because we realize the time it takes to go through the process. But yeah, I think ultimately it'd be great to get more exposure for Live Oak within our network. I know we've kind of talked about, walking through process on a few deals, and I think we will be working on some shortly. But yeah, I'm excited just to understand kind of, how your team operates. And I know just on the public facing piece, like we're transparent about what we do. And I think a lot of people could learn not just from the podcast today, but going forward, I'm sure we could have some really good kind of shared content just to make sure that buyers and sellers are getting into this for the right reason and
Yeah.
have good expectations set early.
Yeah, absolutely. I think as much education, or not even education, but just conversations helps people kind of understand what this can look like for them.
Any last words, comments, thoughts, concerns, questions that you want to throw out there, Jordan?
I hope my husband has dinner on the table for when I get home.
Sorry,
Right.
so sorry for taking you so long here.
I'm just kidding. No, I welcome any conversation, any opportunity, any phone call, email, Teams call for any buyer or seller. We somewhat pre-qualify sellers as well, just like we do buyers, and explain again, this will be impacted depending on a buyer, but happy to have any further conversations with any party that just has general questions or wants to talk through potential structures.
All right. Well, thanks everyone for joining us. Jordan Coleman, Live Oak Bank, thanks again for jumping on. You had to suffer through that with Hunter and I. We had a lot of fun. I hope you had a lot of fun too.
I did. I could be doing worse things. So I appreciate the invite, appreciate the conversation, and looking forward to doing a few more.
Excellent.
Great.
Hey, thanks so much.
Thank you guys.